and welcome to the latest edition of International Tax News. I'm Doug McHoney, PwC's International Tax Services Global Leader. In this edition, we cover selected tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in-depth on similar topics, check out the Cross-Border Tax Talks podcast, in video on YouTube or in audio wherever you find your podcast. Now turning to our current edition. First, the OECD side-by-side agreement was released on January 5th. The new package of administrative guidance includes a permanent simplified effective tax rate safe harbor, a one-year extension of the transitional country-by-country reporting safe harbor, and a substance-based tax incentive safe harbor. It also importantly includes a side-by-side safe harbor and an ultimate parent entity safe harbor for eligible countries, which are subject to future stock takes. The package memorializes what was agreed between the G7 members last June, which should address U.S. proposed Section 899. While we wait for countries to enact, it is now clear that all in-scope multinational enterprises, including U.S. companies, will have full Pillar 2 compliance for 2024 and 2025. Next, Pillar 2 regimes around the world are refining their compliance regimes. In Singapore, for example, the Inland Revenue Authority published guidance on the online registration process for multinational and domestic top-up taxes. Depending on their financial year-end, M&E groups will have to notify the tax authority starting in May 2026. In Luxembourg, authorities opened the Pillar 2 registration and tax filing process in early January. Registrations and first filings are due 18 months from the close of the first Pillar 2 year, which means June 30th, 2026 for calendar year groups in scope since 2024. Many of the other 34 countries that enacted Pillar 2 continue to define and refine their local compliance requirements. Check out PwC's Pillar 2 country tracker for more information. Moving on from Pillar 2, China recently released its 2025 Encouraged Industry Catalog for Foreign Investment, which serves as a key policy guide for foreign investment in China. The catalog provides guidance relating to foreign invested project approval, preferential tax treatment, and regional investment layout. If a project qualifies, preferential treatment may include tariff exemption for certain imported self-used equipment. In addition, companies may benefit from a 15% corporate income tax rate for investments in certain regions and a tax credit for direct reinvestment of foreign investors using profits distributed from tax resident enterprises in China. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition and on the next episode of the Cross-Border Tax Talks podcast.